Hello and welcome. My name is Dervedia Thomas, Associate Editor for FundFire at the Financial Times. I'm delighted to welcome you to our panel on Beating the Index. Today we'll discuss the biggest successes in European fund management, what they're doing differently, and what impact branding has on their success. We also want to hear from you, so don't forget to submit questions in the chat box to the right of your screen throughout the session. And you can post on social media using hashtag CrossborderLU or hashtag Crossborder2021. On our panel today, we have Shelly Antoniewicz, a Senior Director for the Investment Company Institute, and Chris Chancellor, a Senior Director within the Global Insights team at Broadridge. Thank you, Chris and Shelly, for joining us. Shelly, 2020's first quarter saw the return of volatility as the pandemic began, followed by a sharp recovery. So, where did the money go?
Well, money market funds, because of the flight to cash in Europe, actually received almost 250 billion euros. So we need to mention that right at the outset. Let's move on to the more interesting categories, which is long-term funds. So open-end UCITS and ETFs had about $380 billion in inflows, even in the volatile year that 2020 was. Now, if we look splitting that between ETFs and sort of your traditional UCITS, ETFs received about a quarter of that inflow, so a little over 90 billion euros. We also want to look at active versus index. So looking at the universe of UCITS, traditional UCITS and ETFs, active funds received 62, or about 2/3 of the inflow of that 380 billion, 80 billion euros. So active funds are very much alive in Europe, and they're receiving quite a bit of cash. When we want to look at sort of what were the top categories, I looked at the top 5 categories that received inflows in 2020. The largest one was global large cap growth, and that category received 39 billion euros, about 10%, a little over 10% of the total inflow. The next category, I don't think anybody's going to be surprised by: technology. Sector equity technology received 36 billion euros. And then the third category, which I was a little surprised by given its performance, which we'll talk about later, or its relative performance compared to some of the other categories, was global large cap blend. That one was a little bit of a surprise, and we can talk about some of the reasons why we think those types of funds received inflows. The fourth one, again, is not a shock given sort of the current environment in moving and the heightened awareness of climate change. Ecologies, sector equity ecologies were in the top 4 spot for inflows. And then sort of rounding out the top 5 is our first bonds. So European corporate bond funds received inflows of about 18 billion euros in 2020.
Great. So we're going to dive into some of those reasons. But first, I want to go to Chris to see what kind of trends he's observed in the flow data, and perhaps learn a little bit about which fund groups got a lot of money.
Yeah, so I mean, Shelley's right with her trends. They echo what I would see. The big areas for us is thematic investing. That was a big area, really about groups not just being in a certain sector, but also being able to tell a story. So the marketing element there, and allied to that, really the whole ESG piece. So if we look at some of the groups that won, it sort of shows a number of these trends that we saw anyway. So right up at the top last year was BlackRock. If we take out money market funds, BlackRock right at the top, around 80 billion euros of flows to that group. Now that was 4 times the next best-selling group. So whilst passive had a pretty good year, BlackRock scooped up a huge amount of that passive flow themselves. So that was big business for them. Away from that, JP Morgan did very well, playing some of that thematic piece. Pictet there as well, again, with the real thematic piece in terms of investing there. They've been bringing theme funds to market longer than anyone else. They have by far the best brand in that space, and that really played well for them last year. And then the last group I'll kind of pull out, not the third or fourth in terms of flows, but just really interesting, gathered a lot of money, Morgan Stanley, and that concentrated global equity play they have, drove a lot of flows for them as well.
Interesting. And Shelly, as you look at that list of categories that received money, walk us through some of the reasons why those types of funds, or we saw the flows go into those types of strategies.
Well, it's not surprising for large cap growth. They had really very good performance in 2020, so it's going to attract flows. We know that, there is a tendency for flows and performance to be correlated. It's not the driving force, but at the margins, there is movement into funds that tend to have, look like they're on the upswing. And given that the markets dropped so precipitously in the first quarter, I think people, for years and years, we've seen this sort of buying on the dip. Well, in March, from the peak in February to the trough in March, we had a 30% dip. So a lot of people looked at that as a buying opportunity and being able to get into those funds where you could get that upside exposure. So not surprising about that at all. I think the technology just speaks for itself. I mean, we have all of us right here are all at home. We're relying so much on technology right now to do work. And that was also an excellent performer last year. And I think will continue to be into the future. We've all learned how to be very productive at home. And so I think we may see some structural changes in the economy related to that. And then again, blend was kind of a surprise here, but prior to moving over, Chris and I were talking and we kind of feel as though, I don't want to put words in your mouth, Chris, that, blend is a combination of, as he was mentioning before, the branding and the marketing, but also, investors need diversified portfolios. You can't, always be in the highest performers because, I have a PhD in economics, and the first thing we learn is risk return, right? Higher expected returns means you're taking on a lot higher expected risk. So you want to diversify your portfolio. And perhaps investors were looking at a defensive position in blend. Chris, do you have thoughts on that?
Yeah, I mean, I think you're right. I also think, if you think about the distribution landscape in Europe and more money going to discretionary advisors, going through model portfolios, that's some of that dislocation we saw in March, where we saw a huge sell-off in bonds, but actually we saw money coming back into equities as soon as the market hit bottom. Some of it was about buying cheap, and some of it was about people just were forced to buy because their models were now out of line. So they were forced sellers of bonds forced buyers of equity. And then in April, as markets came back, we saw that unwind. So we're talking about the whole year here, but certainly around that period, you get some crazy trends going on and things that don't make a lot of sense until you look under, well, what's the model that's lying behind all of this?
And Chris, you mentioned Morgan Stanley and their global equity flows. Was that an actively managed strategy that investors pulled money into?
Yeah, absolutely. So they have a few kind of really significant funds in Europe, global opportunities, global brands. They've been around for a long time. They're actively managed. They tend to be quite concentrated portfolios, which has been, this is a trend we've seen for a decade now, if not longer, that investors, when they want to go active, they quite often want to go really active and have a manager that's going to have, well less than 100 stocks, certainly. And when we look at some of those thematic investing sectors, maybe consumer goods or circular economy, things like that, those portfolios tend to have number of stocks of 30 or less quite often. They are really concentrated, and investors like that. It's like, well, if I want something big and diversified, I can go passive. But if I want something that's where I'm going to buy the conviction of the manager, I want the conviction of the manager to be very clear that it's a short list.
Great. And we have a question from the audience, and I'm probably going to add to it a little bit. Are there any trends in terms of flows into industry or geographies? And do you have any predictions in terms of where those flows will continue to go?
Yeah, do you
Well,
want me to think about it? Sorry, go on, Shelley.
no, I would just say in perusing the data, I saw that there were definitely flows going into China. There was quite, and also into just Asia in general, emerging Asia.
Yeah, it's interesting because emerging markets as a whole wasn't doing very well in terms of flows, but Asia, and then you're absolutely right, China, and especially China A shares, which was opening up as a
Yes.
market that took a lot of money. Where's it going to go this year? So we talked to fund selectors and we asked them where are they going to place more money. And the top two, I mean, it's no surprise it follows on from what we saw last year. The top two by far are ESG and thematic investing. Those are the two spaces they're expecting to put a lot more money over the next year.
Now, actively managed strategies in general have been suffering. And did we see more flows go into actively managed strategies this year, Shelley, as opposed to years prior?
Actually, actively managed funds in Europe do quite well in receiving flows. I mean, generally they receive the bulk of the inflows, and 2020 was no exception to that. And as I mentioned earlier, they received 62% of all of the traditional UCITS, and that includes ETFs together, flows.
Oh,
So
interesting.
in
Uh,
categories, the large cap, the global large cap growth category, which received the most, I would say nearly all of that, less than 1 billion euros, okay, went into index. All the rest of it went into active funds.
Great. And Chris, you mentioned some of the active players like that have done well, like BlackRock, JP Morgan. Has
Mhm.
there been a pattern with those firms over a longer term period in terms of how much they've been able to attract to their actively managed strategies?
Yeah, I mean, when you widen that lens out and look, say 3, 5 years, the top three groups in Europe, well, two of them are passive. So BlackRock taking a lot of money, and in BlackRock, I'm including the iShares business in there as well. Vanguard equally taking an awful lot of money, and then third is PIMCO because I think, as Shelley said earlier, bonds has been a big trend in Europe for a long time, and last year was a little unusual that there was quite a flow into equity. But there have been players that have done well over a longer time horizon in terms of active as well, and some names that aren't so familiar globally. So groups like Robeco, Natixis, Candriam have all done particularly well. And again, I'm sort of coming back to these points about thematic investing, ESG investing, a bit of factor investing in there as well. That's gone down pretty well with, say, institutions coming into funds. That's been pretty interesting as well for some groups.
Great. And Shelley, have you noticed any trends over a longer term period, maybe 3 or 5 years, in terms of where people are allocating money, whether it's passive or active strategies?
Well, I mean, as Chris said, the bond category always tends to be, as sort of an overarching category, tends to be the winner, at least in the last decade. As we have seen the demographic shift, the aging of the global population, we're seeing more and more money moving into the fixed income space.
And as we look at ESG, Shelley, how have the flows evolved in the ESG space, and should we expect to see that continue long term?
Oh, absolutely. This trend is not going to go away, right, Chris? I mean, this is here to stay. Um, Looking at brand new funds that just started in 2020. So there were 459 brand new ESG or sustainable funds that came out in Europe. Um, and those funds alone received 36 billion euros in. And if you look at 2019, there were 360 new funds that came out that were sustainable. And they also received over 30 billion in euros in their first year. So there is a lot of demand. Chris has some overall numbers on the ESG sustainable funds, and the growth rates are tremendous on these.
Chris, how are you seeing the sort of flows move into that space?
Yeah, so I mean, Shelley's right. We look at these numbers all the time, and actually, I don't have a client conversation anymore that doesn't pretty much start and end with ESG. You know, it is everyone's focus. That's for a couple of reasons. You know, there's a regulatory agenda in Europe that's been driving that, but it's been client led to a large degree. Clients have wanted to get into this. So if we look over 5 years, ESG has gathered around €500 billion, but pretty much half of that number came last year, and it's been building up and sort of almost doubling, so exponential growth in terms of flow every year. And a lot of that is rotation. So rotation from funds that maybe aren't doing good, or at least maybe we say they're ambivalent about doing good, to those that are doing good. We then cut the universe down into five big brackets to take a look at, from sort of the old exclusionary approach, if you like, right through to something sort of engagement, and then through to impact as well. And what we're seeing is there's still money flowing into things like exclusions, but as a share of ESG flows, what we're seeing is more investors moving to things where they can actually measure the difference they're making as an investor. So that's the engagement piece, that kind of best in class positive screening piece, the impact piece. And I think that's about ESG just changing as investors get more aware of what different flavors there are in terms of ESG out there. It isn't just one thing, it is multiple different things. And I think all of those will have a future. But we're definitely seeing that shift towards impact, towards the ability to measure right now. What if I had 30 seconds more on that? I guess what that means for firms is then their ability to report and be able to engage with investors and help investors understand what they're doing, how those investors are having an impact. That's going to be really valuable going forward.
So if engagement is such a big part of the process, um, and perhaps I'm wrong, but is this more of an actively managed push, or are index funds also attracting a lot of flows in the ESG space? And perhaps I could toss that to Shelly or you, Chris.
Yeah, I can pick it up to start with, and then I hand over to Shelley. I'll just say, I mean, both actives and passives are now playing in this space. So it was predominantly active until probably 2 years ago. Passives have got stronger in there. Certainly, things like impact. Yeah, there's much less passive. That's an active play. The other spaces there's passive, but in every one of those categories right now, we see active outselling passive.
Shelly.
Yes, that's the, I completely, I'm seeing the same thing. We're all, Chris and I are looking at the same data, so we're seeing the same trends.
Wonderful. And Chris, are there certain fund groups that are really dominating the ESG space?
Well, that's interesting, and I think that brings us back. Everything brings us back to the active and passive debate, doesn't it? Because actually, the fund group that is dominating last year was BlackRock. So, wasn't really highly regarded as an ESG brand some time ago. I think we've seen them get more focused on the products they brought to market, more focused on their ESG messaging, and more focused as a corporate entity on ESG. There's not many weeks go by that from Larry Fink down, they're not making some announcements around ESG. So they're there, and they're gathering a lot of the passive flows outside of them, and certainly the active space. It's a lot of the pan-European names. So Pictet, Robeco, Natixis, Candriam, and then some others who've got strong captive distribution. UBS, who I think made their announcement last year that for most of their clients, ESG was going to be about opting out of ESG rather than opting into ESG. So their model portfolios were generally going to be have ESG credentials. And then I think the other one that's up there at the moment is Intesa San Paulo. So, again, very strong captive distribution. So we're seeing ESG everywhere, active, passive, global players, local players, and across the spectrum of distribution from those with real captive local distribution to those using third parties.
And as we talk about beating the index, Shelly, are there certain sectors where active managers have been outperforming or outperformed last year or over a longer term period?
Yeah, absolutely. I just did a comparison. Now, not every Morningstar category that I looked at has a comparable index fund. So the ones where there were comparable index funds to then compare that performance to active funds, I just did sort of a simple average across the funds in each category and looked at the differential in the performance between active and index, as a whole. And one thing that was very interesting was in the China equity category, active way outperformed the index by over 17 percentage points. So that definitely was notable. Hong Kong also. So if you separated out Hong Kong as a separate category, active outperformed by about 24 percentage points. So
Wow.
that's interesting. One thing, there were some other areas, communications, and when we're looking at some of these nicher, sort of, I call it nichier areas, that's really where active has some strength because they're able to go in, do the research, be able to really get into the nitty gritty of the details to look at where there could be securities or companies that are being undervalued. Truly becoming experts in those more niche areas. And then it can show in the performance compared to an index, which is generally market cap weighted.
Chris, are there any fund groups really consistently beating the index?
On a group level, I don't think so, really. I mean, everyone has good and bad at different times and within their ranges. I guess, one thing I think about this is beating the index the question? I think, it certainly was the question some time ago that, product mattered most of all, and, it's about performance. I'd argue right now that the industry is shifting much more to a service model. Brand is important, storytelling around your products is important. So, performance will always matter, price will always matter, but I think there's a whole load of other pieces coming in. And certainly when we think about ESG, it's no longer just performance. I mean, there's some pretty good arguments that ESG may well enhance your performance, but it isn't just performance. That isn't just why people are investing anymore. It's the engagement as well. So I think there's other pieces there that are worth thinking about rather than just performance.
Great. And
Yeah,
as
and
a quick
Chris is
one word,
absolutely.
oh, oh, go ahead, Shelly.
No, I was just going to say Chris is, picked up on one point, which is there's definitely more of an emphasis on cost, and so fees, fund fees, and ongoing charges are becoming, very much of a focus. And so when you're looking at all these performance numbers, in fact, the ones that I just quoted, they're all net of fees as well. And that's a lot of pressure on the active managers to make sure, because of the fact that the infrastructure they have does cost more than an index fund's infrastructure. They have to deliver, and the way that they deliver, not only through service, or perhaps, as Chris is talking about, also through the ESG space, but is all through performance. So they have to make sure that they're at least managing to meet that index benchmark return.
And if we could do a quick lightning round, thanks so much, Shelly. where you just give a one-word answer. Are there any trends that are being accelerated by the digitization of the industry, which has been brought on by COVID? Quick one word, Shelly.
Technology.
Great. Chris?
Remote servicing.
All right, great. Thank you, everyone, for joining. Next up, we have my colleague, Katie Martin, joined by Catherine Koch in the next session, which starts in 5 minutes. Thank you.
Thanks.
Great, thank you.